Now that we have our balance sheet done, let's go ahead and copy and paste it over so that we've got our full balance sheet projected out through 2020. Did the same thing for liabilities and equities now as we've done for our assets, and we can see that we're still out of balance. The reason being we haven't fully reconciled what happens to cash. So let's go over and move to our 2016 projections for the statement of cash flows. Net income is going to be equals to the net income line we pull in directly off of the income statement. Depreciation will be pulled in directly from the total depreciation line off of the assumptions page. Now, you may have noticed, if not, rewind and look quickly, you would have seen that the amortization line appeared right underneath the depreciation line on the assumptions page, so I can just copy and paste that down. Now, changes in working capital is a little bit tricky, and again, the way you want to think about this is, if our accounts receivable balance went down, that means our cash balance should go up as compared to the amount of actual sales that we had. The inverse is true too. If our accounts receivable balance went up, that means as compared to the sales number we had, which again is assumed and reflected as being all cash and collected here, that would mean that that receivables balance increase actually had a negative effect on cash. So the formula we're going to use here will be equals to, and we're going to go out now to the balance sheet. And when we look at the balance sheet, we can see that the accounts receivable balance between last year and this year went down greatly, which means our cash collections should have gone up even more. So our formula is going to be previous year minus current year. Now look closely, you'll see that inventories and other current assets are sitting right underneath. Inventories balance went way up, which means that our cash balance should be negatively affected. And then other current assets went up, which also means our cash balance should be negatively affected. But watch this, because once I hit my formula here, and I know those two things were sitting right underneath, I can just copy and paste down again. Now, accounts payable works the inverse, as do the liabilities. If your accounts payable balance went up, what that means is you assumed you paid expenses in here that were actually liabilities that have not yet been paid. So the opposite would be true once again, which is if your accounts payable balance went down significantly, what that meant is you actually made more payments than are reflected right here. So our formula is going to be equals. We go back to our balance sheet and we look at our accounts payable and we see that our balance went down significantly, which means that we must have paid them. So our formula is going to be current year minus previous. And again, because of the way we structured that, we can copy and paste and put those things straight down. And now we can add up our total changes in working capital. Alt-HUS, enter. And then our total cash from operating will be the 21.9 plus the 1,000,005 plus the 50 minus then the total changes in working capital. So you can see, oops, that shouldn't have been minus, that should have been plus. So let's go fix that formula real quick. You can see that our cash balance actually went down by 3.37 million, primarily because we invested in so much inventories, we paid down some accounts payable, and our accounts receivable actually brought us in some more cash, but the collective benefit to us, inclusive of this net income figure, is actually negative. So let's go down to investing activities. Capital acquisitions will be equal to, we pull that right off the assumptions page for CapEx acquisitions. Again, dispositions was right underneath it, so I can just copy and paste. Now the way we want to think of this, acquisitions would be a negative number. If you acquire something, it's negatively effective to cash. Dispositions would be a positive number. You sell something, you get cash. So how much cash would we get from investing activities? It would be equal to dispositions minus acquisitions. So think about it. If we had $100 that we got for selling an old piece of equipment, but we spent $20 million to get a new piece of equipment, the number that would come in here would be negative. Moving on to our financing activities, again, we're going to make references right to our assumptions page where we could borrow and or we could borrow specifically for CapEx. We also might pay back. I could just copy and paste here, but I'm going to show you again, equals the assumptions page. We could pay back for CapEx. And then dividends, which will be a straight assumptions page pull in. And so we ask ourselves then from a cash flows point of view, how would these things affect cash? Well, if we borrowed, that's a cash inflow. So we would subtract off a payback, which would be a cash outflow, and we would subtract off a dividend, which would be a cash outflow. So our total increase or decrease in cash would be equal to cash from operating plus cash from investing plus cash from financing. And now that we've got that and save it, let's go look at our balance sheet and see what happens. That our balance sheet now is actually in balance again because now we have reflected that $3 million negative change in cash from year over year. Let's go back and look at our income statement for a second and see if indeed our interest expense net line changed from the first time we went through this, because now we have the balance sheet projecting us total debt all throughout our 2020 period. One thing though we notice is that our balance sheet is still not in balance moving forward because we have not completed our statement of cash flows. So let's go ahead and copy and paste everything that we have on here. So we copy and paste a little bit too much there. Copy and paste everything from the operating section. Let's go ahead and copy and paste everything that we have then in the investing section. We'll copy and paste everything related to the financing section. And lastly, copy and paste everything as it relates to the net change section. Save it, and let's go ahead and take a peek at our balance sheet now. And indeed, every single one of our years now balances. So we now have a fully functional financial model.